All right, what's up, everybody? Super excited for today's video. The S&P 500 has sold off significantly, and everybody is wondering, is a recession coming next? So in today's video, we're going to do a very brief breakdown of some of the technicals on the S&P 500, hitting its 200-day moving average, retesting a Fibonacci zone, my thoughts on that. But we're also going to talk about the yield curve. Everybody was talking about the yield curve in 2024, saying how, after the yield curve inverts, once it's uninverted, typically a recession follows. That's all you heard about throughout the entire year of 2024. And now magically it's gone away, right? And people still are forgetting about that. And it's definitely a valid concern. We've also got economic expansion breaking down here via the stock market, right? And economic contraction potentially breaking out. Okay. These are things we don't want to see continuing if we want this bull market to last and we want to avoid a recession. We've also got the EPR model, which is the employment population ratio model. All right. And we're not going to dive too deep into that, but rather just go over the signal and what we're looking for in terms of a recessionary signal. We've got the percentage of stocks above their 50 and 200-day moving averages. We've also got our risk on ETF down on the year, about 4.5%. Meanwhile, our risk on ETF is up almost 9%. And then we've got more and more stocks making new lows, right? To go into a bear market and to, if we're going to experience a recession, you're going to see the number of stocks making new lows continue to expand. And that's exactly what we're seeing right now. We've also got lower highs on the high-low index, trading below zero on the high-low index. And a lot of things when you look at if the market is defensive right now or offensive, is very defensive, right? And high beta, low volatility breaking down, discretionary versus staples breaking down, credit spreads on the verge of breaking down, and biotech just unable to catch a bid for really the past year. So we'll break all of that down. We'll also talk about the skew index. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through that disclaimer. I do want to mention I have a completely free newsletter for you guys. It's called Investment Intelligence, and I give out free, valuable finance and trading related content as well as free trade ideas. All right. Now, if you want to, you can join our private trading group using promo code Powell. All right, that promo code will get you guys 50% off for your first 2 months. Right, so a very nice discount for your first 2 months. See if it's something that you guys enjoy after your first 60 days and whether or not it's something you want to stick around for. Inside, you're going to get 20 plus swing trade ideas weekly, custom scripts, indicators, and exclusive chart layouts that we're going to be using in today's video, as well as exclusive intel. Now let's start off here with the SPY, the S&P 500, and get straight into today's video. The blue line here is going to be our 200-day moving average, and you can see we've come down and we have crossed below the 200-day moving average. Typically, you tend to go a little bit lower, right? It's not a perfect bounce area, right? We had the bear market here, and you can see we're trading below that 200-day moving average for a long time. But even when we retested it, we came down, well below it before finally recovering. So to me, would it make sense if the SPY comes down towards the 560 area? Discord members know that I was mentioning very early, hey, if we break these areas around the 573, I think it was, the SPY is going to move down quickly to 565 to 560. And sure enough, Friday we bottomed right around 565. Whether or not that's a long-term bottom or just an intraday bottom is to be determined. Okay, but I really like this setup here, all right, because all we're simply doing is retesting old resistance, right, old supply here and here at a key Fibonacci level extension, which makes a lot of sense to me. And now we're potentially, gonna bounce off of here, right? It's a very logical place, right? Now, the big thing is if we break the 560s. If we break below the 560s, next support level is going to be right around 540, and that's going to be well below the 200-day moving average. So, when we're trading that far, if we are trading that far below a 200-day moving average, that sets up a lot of opportunities for dead cat bounces, right? Where you see a drop here, you pull back up, and perhaps we retest that 560 to 565 zone, and our 200-day moving average is starting to flatten out here. It's not going to be a great look, right? Take a look at where we're at right here and right here. Very similar, right? Where we start to break it out and then it starts to flatten. It's very choppy. It goes down below, dead cat bounce, new lower lows. right? And then another dead cat bounce, and then ultimately we just continue selling off in the market. So that's a very real possibility if we're trading below the 560s, right? That this scenario could play out. Anything above the 560s is very healthy to me, okay? And now it doesn't mean that we can't break down below, recover, reclaim the 560s, and then continue to go back towards all-time highs. That's definitely a possibility. But if you had to put a line in the sand, okay, 561.50 right here, our Fibonacci extension, basically the 560 to 565 zone is very important for me. And where we are, I think, a couple weeks from now, and a couple months from now, in terms of that level above and below, is going to be pretty significant. Now, back to the yield curve, okay? We have the Fed funds right here on top in red, the yield curve, the 10-year, 2-year yield curve in blue, and we got the S&P 500 on the bottom. Now, the Fed funds rate, typically you start to see these cutting cycles and you'll see the yield curve rise. Okay, that's very common. That's exactly what we've gotten here. The Fed has started cutting. We see the red line go down, and we see the blue line is no longer inverted and is rising. But the big thing is when it is inverted, right? When it's below this zero line right here, and we uninvert and we come out of that inversion, which is typically followed by a Fed cutting cycle, you can see the performance of the stock market is not great. And oftentimes this leads to a recession. Okay. Once we have an inverted yield curve, a majority of the time a recession follows. It's not every single time, but a lot of times. And this is something that all the bears were talking about all last year. And it seems that everyone's completely forgotten about it. So, in terms of risk to the market, and is there a risk of recession? The yield curve is still the yield curve risk, and the yield curve inversion that we had is definitely still a major risk to the market. Um, when we take a look at this right here, what I've done is I've created a script to measure the economic cycles, right? You've got expansion, contraction, you've got recovery, different things like that, right? Different stages. And when we take a look at just these two, expansion and contraction, I wrote about these in the newsletter here recently, last weekend. We did not want to see expansion breaking down, right? We see that we had already broken down, and this past week we've continued to break down even further. That's not a great look. We saw contraction, broke out, retested, and still holding above those breakout levels. Okay, and so what this means and how to interpret this is the market is pricing in less economic expansion and more economic contraction. Okay, and so when you think about that, that's going to be leading to, decreased multiples potentially, right? And decreased valuations, okay? AKA a sell-off. And sure enough, the market did sell off some more this week. So it's very important in a lot of these things. And, I'm going to continue to monitor them throughout 2025 to look for those confirmation signals, right? If we're really worried about a recession, we really want to know if a recession is coming, the market is a great place to look and see what it's telling you. And it's telling us right now that maybe we're not pricing in a full-blown recession, but they definitely are pricing in economic contraction, right? And if this reversal follows through and this reversal continues to follow through even more, that's going to be more and more of a sign from the market telling you that a recession is coming. Now, another big warning sign that we're looking for in terms of recessions is going to be the labor market, okay? And we can go over the unemployment rate, and different things like that. One thing that I learned a couple years ago, maybe a year or two ago, was something called the employment population ratio model, okay? And this, abbreviated is just going to be your EPR. And so this chart right here, we're mainly measuring the score, okay? Green is good, yellow is cautious, red is recessionary. Okay. You can see the last two times that we flipped to red here, the stock market experienced bear markets and the economy was in a recession. We had the pandemic right here, a brief little blip. So we're not too concerned about that. But we've been here in this cautious sign for a while now. Okay. We've been here for a while, and it's something that I've been watching and watching and watching. And if this goes red and continues to stay red, that's not going to be a great look. Okay. And that's definitely a recessionary signal. All right. And basically what you're doing is, you're taking a look at the rate of change of employment, and obviously the employment population ratio, right? So out of the population, how many are employed, et cetera. We're not going to dive too deep into the mechanics behind, how the score and how the model are developed. But this is something that I created a script giving the guidelines of that employment population ratio model. And, it's definitely a cautionary, right? And the labor market is really the big thing that the Fed is worried about right now. Yes, the tariffs seem very inflationary, but the market is telling you that it's not too worried about inflation. And the Fed is telling you they're not too overly concerned about inflation either. It's really more about the job market and the labor market, okay? And obviously, this right here is also flashing some warning signs. So if we continue to see the labor market deteriorate, and we don't know how Doge is going to affect things, laying off all the government workers, not to get political or anything, we just don't know what the impact of that is going to be, and what that's going to look like, what numbers are going to show up as a result of that. Then we've also got the stocks, the percentage of stocks trading above their 200-day and their 50-day moving averages is now below 50%. So what that means is that more than half of stocks in the stock market have lost both their short term, which is the 50-day moving average, and their long term, which is the 200-day moving averages. So breaking down from losing your short term and your long term trends is not bullish, right? And that's not a great signal. And this is something that we mentioned as well last week and in the newsletter for what to expect this week, right? If this can hold above 50% and start to go higher from here, then expect the stock market to start to rally perhaps. But if this falls below that 50% level, then that's not going to be a good look for the market. And most likely, we're going to see more downside in the market. So the longer that these two stay below 50% and the lower they go, the worse, or rather, the strength of this sell-off increases, and the validity of this sell-off increases even more. Um, then when you look at, just some basic things, right? Hey, is the market risk on or risk off, right? Some people like to look at tech to measure that. Some people just look at Bitcoin, different things. But if you really just want to measure, what I've done here is created a couple ETFs. We have the risk on ETF on top, and we've got the risk off ETF on the bottom. And you can see a very big difference in those charts, right? This one is lower left to upper right. This is our risk off ETF. And then the risk on ETF, really, it peaked in the summer of last year and has continued to just really go lower. It's range bound, that's for sure, but it's in the bottom half of the range, which is symbolizing weakness in terms of risk on. So the market's definitely not risk on. It hasn't been very risk on for quite a while, and risk off has really been leading the way. Now, for a bear market to occur, okay, you need to have stocks making new lows. It's just that simple, right? And I may be oversimplifying things, but if you're going to look for a stock market, a bear market in the stock market, remember that the stock market is nothing more than a market of stocks, right? A bunch of different stocks. So if you're going to see those extended sell-offs and you're going to see, selling persist and continued strength in selling, then you need more stocks to make new lows. And that's exactly what's been happening on a 1 year, on a 1 month, and a 6 month. So this is also both short-term, intermediate, and long-term. We're seeing new highs expand, or I'm sorry, new lows expand across the board. This is not a good look, okay? It's a lot different if you only have one of these, right? We were only seeing stocks making 1 month lows expanding, we'd be a little bit cautious. We'd say, hey, the number of stocks making 1 month lows is starting to rise here. Let's look out for, some potential weakness in the market, or let's see if this evaporates, right? And we start to see this trend back lower. And when you see the number of stocks making 1 month lows expand, you don't want to see that expand into the stocks making 6 month lows, right? Because then it's just further increasing the strength of the sell-off. And then from the 6 months goes to the 52 weeks, that just again further increases the strength of the sell-off. And when you take a look at what we've got, it's all across the board. Stocks are making new lows on short-term, intermediate, and long-term basis. And on a long-term basis, we've had the most number of 52-week lows that we've had in a year. Okay, so you're seeing more and more stocks hitting 52-week lows every single week over the past few weeks and throughout the month of February. It's not a great look at all for the stock market and the strength of the bulls. Now we have the high-low index here on the top versus the S&P 500 here on the bottom. I wanted to show this to you guys. This is going to represent the number of new highs versus new lows in the stock market. And also, it can provide some really good signals. Okay, so let's talk about what those signals are, whether they're buy or sell signals, how easy they are to identify, and how you can potentially capitalize on them in the future. So we see the S&P 500 doing something simple called making higher lows, right? Higher lows here and higher highs, right? So we're in an uptrend. Meanwhile, if you look at the high-low index, it's in a downtrend, right? You have a high, you have a lower high, you have a low, you have lower low, lower low. So if you think about this and we remember the very basics, right? And we oversimplify things, the stock market is nothing more than a market of stocks. If we're continuing to head higher and making new highs, well, the new highs should outweigh the new lows, right? So when you look at the high-low index and you compare the new highs versus the new lows, if this is breaking down, this is telling you that the underlying trend is getting weak, right? And that this could lead to a potential sell-off or correction in the market. And that's exactly what we got, right? And we've seen that. Same thing happened over here, right? We have the number of stocks, we have the stock market going higher, creating higher highs and higher lows. But meanwhile, the high-low index, again, the number of stocks making new highs versus new lows is now lower, right? And this happens for a different variety of reasons. There can just be a few stocks that are really, heavily weighted that are carrying a lot of the gains for the overall index. That's why diving beneath the surface and underneath the hood of the market really helps out a lot and provides these types of signals. And, we saw another signal over here, led to about a 4-week sell-off. And here we are again, continuing to make higher highs, but we're making, a high here, a lower high, lower high. We're making, low, lower low, lower low. So we've got a clear downtrend in the high-low index. That was a bearish divergence, okay, meaning that, this is bearish while this is bullish. So the divergence between these two, using our indicator on top, the high-low index, the indicator would have a bearish divergence. And we've seen 3 weeks of selling since, during this time period here. All right, we had about 4 weeks over here. We had about 3 weeks over here. Only had about 2 weeks here. And, over here, this ended up, leading us into the bear market that we had most recently, our most recent bear market. So these are all things that I'm watching, right? And we're below zero on the high-low index. We need to get back above zero, and we need to start putting in some higher highs. Now, if you want to know if the market's defensive, right? So we talked about risk on, risk off ETFs, whether or not the market's risk on or risk off. I also like to look at things are offensive or defensive, right? High beta versus low volatility. High beta stocks outperform low volatility stocks in a healthy bull market and in an offensive market environment, right? Discretionary versus staples. In a healthy bull market, consumer discretionary stocks are outperforming consumer staple stocks. You've also got credit spreads here and biotech. And if we take a look, these two are the most important ones breaking down, really justifying a lot of this sell-off in the high beta, low volatility ratio and the consumer discretionary versus staples ratio. If biotech and credit spreads start to look like this, then it's very likely the stock market's going to continue heading lower. Now, you may wonder why biotech is in there. Well, to me, biotech is something that's very risk on, risk off, offensive, defensive, right? Because if you think about it, you're basically fishing in a industry of stocks that typically are profitless and spending most of their money on research and development, looking to, obviously develop some type of drug or cure or something like that along those lines, some type of revolutionary product that they can then make profit on, right? So a lot of times they're burning money and just spending lots and lots of money on research and development until they finally have that breakthrough, get some clearances from the government, FDA and things like that. And we just really haven't seen that go anywhere. For about a year, it's been trading completely sideways. And meanwhile, we have discretionary staples ratio rolling over. We have the high beta, low volatility ratio rolling over. These are not things that you typically see in a strong bull market. And these are all signs of potential tops, right? A lot of these charts that we've demonstrated and went through today if we continue to see further deterioration and we see the short-term trend of, the short-term bearish trend continue, these are all signs that we had, during the last bear market, all right? And as the last bear market began. So if we want to ask ourselves about recession, maybe we want to look at, the labor market, the yield curve, factor some of those things in. But there's also things of there can also be a stock market induced recession. Tom Lee was speaking about this recently on one of his appearances on a podcast. And it's a very simple concept. The U.S. economy is consumer driven, right? We know that the richest people spend the most money, right? And we also know that the richest people own the most stocks and they own the most assets and equity. So if equity start to roll over and, we see a significant sell-off and perhaps we go into a bear market in the stock market, well, it's very possible that these richest people, whose portfolios have been doing really, really well over the past couple years, and maybe that's been driving an excess in spending, from some of their dividends or some of their realized profits and different things like that. And they cut back that spending significantly. That's a big deal, okay? And that could cause a stock market, that could be a stock market caused recession because, again, they spend so much of the money. They spend a majority of the money in the U.S. economy, and the U.S. economy is consumer driven. If we see a significant pullback in that spending from, those top earners, that very well could potentially lead to a recession also. Now we've got the skew index here on the top. I've got these three levels here. Once the skew index comes up to these three levels, it's typically a good idea to start looking at some potential hedges in the market. It also provides a really good buying opportunity when it's at the lows, but we haven't been there in a very long time. You typically don't see those until, we're near bear market bottoms. Now, the skew should move along with the S&P 500. So it's a good thing that it's still not elevated up here. If it was, it would be signaling to you that, hey, we could have potential downside. But, over the past 3 weeks, as the stock market has sold off, the skew has also dropped. Now, if the skew gets back above 155 or this 170 area, and it's somewhere, above those levels, then you do want to be looking at some potential downside protection, right? Or evaluating your portfolio and saying what are some of the risks, and different things like that. So the skew is very useful. I do like to look at it a lot. And it was a really good signal here, right? You can see early in the beginning of the year, the skew spiked up significantly, well above that 170 level, hitting 173. And since then, it's declined a lot as the stock market has sold off. Right now, if you want to gain access to my private trading group, to the Investment Intelligence private trading group, use promo code PAL. Okay, it's going to get you guys 50% off for your first 2 months. That's a really good discount. Inside of there, you get lots of things. This is the zone finder. So when you talk about custom scripts and indicators, this is one of them, right? A lot of people, when they begin out trading, how do I draw supply and demand? How do I find support and resistance? Well, this indicator here does it for you. It gives you demand, it gives you resistance, all right, in the form of supply and demand. And the very first trade idea, as soon as I debuted it, I put it out in the newsletter for free. And we had a great setup here. We had a higher low in our demand zone on top of a falling wedge bullish pattern here. And I was able to get into some options, and those options did very, very well within a single day or two. We got these types of returns. All right, so inside of there, you're going to find 20 plus swing trade ideas every week. All right, you get those custom scripts and indicators, exclusive chart layouts, and exclusive intel. Now, if you don't want to pay for anything, that's fine. You can sign up for the Investment Intelligence newsletter. Okay, and in there, I'm going to put out, valuable finance and trading related content, and also try to give out some free trade ideas in there as well. So you can go check out the website, look at it, and read some of the previous articles, right? They're not long reads, they're not too overly complicated. And this is where I try to put a lot of high quality work in, right? And the stuff that I put out, I try to make it really good, really valuable, actionable things that you guys can learn from or take action on if you continue to monitor them in the future. And there's been some really good newsletters in 2025 already that I've published. Now, I also want to mention if you guys want to hit me up for a coaching session, okay, you can book a 30-minute or you can book a 1 hour coaching session by going to my Ko-Fi page. I've been doing these little one-on-one sessions for a few years now, and I decided to, move it over to my Ko-Fi page where you guys can book those at. You just simply click on the commissions tab right here, and in there you'll be able to book a 30-minute or 1 hour. Leave a message of what it is exactly you want to go over, whether it's day trading dynamics, swing trading strategies, or you want to have an interactive Q&A. We also have this cool little buy a coffee button, basically a way to leave a tip or donation for all the free valuable content I put out, such as these videos and such as the newsletter. It's just a way to show your support. So appreciate y'all watching. Be sure to smash that like button and subscribe, and I'll see you in the next one.